free cash flow for the firm method. That is what we understand. Its calculation is extremely simple. Everybody is supposed to pay attention. We start with the earning before interest and taxes. We make the computation of the income tax. Then we make the calculation of earning before interest and after taxes. Then we add back depreciation. Why? Because it is a non-cash item. Then we compute CFAT, cash flow after taxes, before interest. That is what we do. Then there are two adjustments that we are required to make. One is capital expenditure and another is a working capital change. These are the two adjustments to be made to cash flow after taxes and before interest, and afterwards we will have free cash flow for firm. Whatever the free cash flow for the firm that we compute, it will be discounted importantly using the weighted average cost of capital or using the overall cost of capital. That is what we understand. That is the way we are required to compute the value of the firm. Importantly, no financial charge will be deducted in calculating free cash flow for firm. Friends, the reason for that is very simple. The effect of the discounting factor is already incorporated in weighted average cost of capital. And we understand that say we are doing the firm valuation. So all long-term sources of finance are taken together. That is the reason so the financial charges are not deducted. With respect to the interest payment, the advantage of the interest tax saving is considered in like the cost of debt financing. Because in weighted average cost of capital, cost of debt financing is taken on the post-tax basis. Free cash flow for firm will be discounted with weighted average cost of capital. Right? This is the next question. Following information are available in respect of highlight the portion XYZ Limited. So the information is provided about a company called XYZ Limited, which is expected to grow at a higher rate for 2 years. So the growth rate is going to be high for 2 years, after which the growth rate will stabilize at a lower level. So high growth rate for the 2 years and afterwards the growth rate will stabilize. Highlight the portion base year information. Means information is provided to us in respect of year 0. Revenue is provided to us. Operating income is provided to us. Capital expenditure is given. Amount of depreciation is given. Information for high growth and stable growth period are as follows. So the information is provided to us about the high growth and the stable growth. Growth is provided in terms of the revenue, that is sales, and EPAT, that is operating income. During high growth period it will be 20% and later on it will be 9%. Growth in the capital expenditure and depreciation is 20%. During stable growth period, capital expenditure are offset by depreciation. It means that whatever is the amount of depreciation itself is the amount of the capital expenditure. The risk-free rate of return, RF, during this period it is 10% and later on 9%. Beta of equity is given to us 1.15 and then 1. Market risk premium is given, it is RF minus RF. It is 6 and later on it is 5. Pre-tax cost of debt is given. It means that the rate of interest information is given. It is 13 and 12.86. Debt to equity ratio 1:1 and later on 2:3. For all time, working capital is 25% of the sales. Income tax rate is only 30%. Assume that, highlight the portion, end of year 3 free cash flow will grow at a constant rate for perpetuity. What is the value of the firm? That is the question. I request all of you to go to the question and then we'll discuss how to do it. Please go to the question. Let us have understanding that's how to make calculation of answer for this very simple question. Dear students, remember that whenever we have been provided with information like capital expenditure, depreciation, working capital, then in that case we always have to follow the free cash flow approach for the purpose of valuation. So over here we are required to make the calculation by using free cash flow for firm approach. Yes, by free cash flow for the firm approach because we are required to make the calculation of the value of the firm. Generally we are having, listen carefully, say the earning capitalization method, wherein net operating profit after taxes is discounted by weighted average cost of capital. This is the earning capitalization method. However, over here, we are required to make the computation. The students will make the calculation of this free cash flow for the firm for the first year, for the second year, and even for the third year. Whatever the free cash flow for the firm for the third year is going to grow at the rate of, at a constant rate for perpetuity, which is provided to us at the rate of 9%. So, we'll make the calculation of the P2 using free cash flow for the firm for the third year divided by weighted average cost of capital or overall cost of capital minus growth rate. That is the way the P2 is calculated. First and second year cash flow and P2, all of them will be discounted to year 0, and with that we will make the calculation of the value of the firm. That is a process which we are required to adopt for valuation of the firm. Dear students, you can see that the information about the risk-free rate of interest is changing, beta is changing, RA minus RF is changing, rate of interest is changing, capital structure is changing. So basically we are required to make the computation of two weighted average cost of capital during the first 2 that is 2 years, and say for the purpose of discounting the third year onwards cash flow. That is the way we are required to make the computation of the weighted average cost of capital, say for like the two separate cash flows for the first and second year, and from the third year onwards for perpetuity. That is what we understand. So let us make the calculation of the answer, and based on that, so we are going to have further understanding. And individually also we are going to discuss the working notes. So the final, like the summary of the entire working. The very first thing that you want to understand is that we are required to compute the value of the firm. Second thing that we understand is the capital expenditure, depreciation, working capital information is given. So always you have to understand that we have to adopt the free cash flow approach for the purpose of valuation of the firm. Third, in calculation of the free cash flow for the firm, we have to ignore the payment of the financial charges. Fourth, we'll discount the free cash flow for the firm. That is, we will discount the free cash flows for the firm, say using the weighted average cost of capital. So the effect of all payment of the financial charges would be covered in the weighted average cost of capital, including whatever the interest that we are supposed to pay, and its tax effect in a way that the interest tax saving say would be covered say in weighted average cost of capital. This is the basic mindset that we should be having say for the purpose of doing answer. Going further in this question, we have been provided with the two separate say the kind of the information for the high growth period and for stable growth period. For the high growth period, that is first and second year, information is provided, and for the third year onwards for perpetuity, again some information is provided to us. That is the way it is divided into two parts. In step number 1, it's extremely simple. We know that there are two segments of the cash flows. So we are making the weighted average cost of capital calculation for the first segment and weighted average cost of capital for the second segment. That is the way for two different segments, weighted average cost of capital is calculated. So we calculate the KD, we calculate the KE, we apply the weighted average. It is extremely simple. The kind of working that we may be doing at our second level. That is the way the weighted average cost of capital is formed. Now you have to be a little bit careful that whenever we are required to make the calculation of P2, then year 3 onwards for perpetuity, the discounting rate will be used, and for year 1 and year 2, we'll use 13% as a discounting factor. So be careful for this point. Free cash flow for the firm, in that there is a small working out of the working capital change. This time it has been given that the working capital is connected with the sales. Sales is growing, along with that the working capital. So difference of the working capital investment is the working capital change for the first year, for second year, and for third year. Free cash flow for the firm is calculated from end of year 1 to end of year 3. First year, second year, third year. For the first year, it is like the 300 crore growing at the rate of 20% and making it post 6. Then it is growing at 20% and then it is growing at the rate of 9%. Capital expenditure, depreciation, both of them are growing in the first and second year. Third year onwards, say whatever the amount of the capital expenditure that you have to make, itself is a depreciation cash inflow. So both of them will set off against one another. Then working capital change, simple information, that is what we already have found. Then free cash flow for the firm. Step number 3, value of the firm. In that, first of all, we'll make the calculation of P2. What does P2 mean? P2 means end of year 3 onwards for perpetuity, whatever you are going to receive, all of them are discounted to the second year end. That is a P2, 8827.20. Lastly, we'll make the calculation of the value of the firm, in which first and second year absolute amount of the cash flow discounted, and then the second year P2 value will be again discounted. That is the way value of the firm is calculated.